let's have a little fun in Excel. We're going to work on two different loan amortization schedules. So click over to the Model tab. Before we get started, you'll see the Macabacus logo here. We have Macabacus plugin enabled on this computer. And so some of the shortcuts I'm going to use are not native to Excel, but rather come from this Macabacus plugin, which we highly encourage you to check out. We have a number of courses on the Macabacus YouTube channel, as well as within CFI. Macabacus is a brand compliance and productivity tool that's very, very popular among power users of the Microsoft Office suite, in particular Microsoft Excel, as you'll see. Now, before we plug any numbers in, we're going to work using a $1 million loan off of a 5% interest rate. We're going to look at two different types of reducing loans: an equal payment loan, which is often known as a blended payment, and an equal amortizing loan, which means that the principal is added, or rather the interest is added to the principal payment in each period. You'll see as we go through. We're going to work off of a term of 60 months. So there's going to be monthly payments. 60 months is 5 years. And we've already put our 60 months in here. So we can plug in 60. That is an input, so that's blue. Same over here. So for both our loans, they're going to be the same. The rate is going to be presented on a monthly basis, since the payments are going to be presented on a monthly basis as well. So in order to do that, we're going to take the annual rate and we're just going to divide it by 12. So there are 12 months. You'll see this is a formula, so it should be black. Repeat over there. And now what we're going to do is we're actually going to calculate a payment amount using the PMT function over here for a blended payment. Again, a blended payment is what most people are going to be most familiar with. They have one monthly payment. It's very similar to a residential mortgage. Within that, principal and interest is embedded. So to do so, we're going to create a formula, and the PMT formula returns a negative number. So in order to make this work and to keep it clean, we're going to put a negative in front. So negative PMT, and we need a couple of inputs to make this work. So we're going to go to rate, but of course the payments are monthly, so we're going to use the monthly rate. The number of periods we know is 60 months. PV represents the present value. So that's the loan at disbursement, the loan amount when it is issued to the client. That's $1 million. Future state or future value, we want it to be 0. So we have to actually type in 0. That means the loan is going to go from $1 million and paid down all the way to 0. And at the end, you have the option to do end of period or beginning of period. We're going to use 0 for end of period. And we're going to do it on the other side, just for consistency purposes. So now we have an actual payment amount, but this is showing as blue, which is an input. That's incorrect. We want that to be black because it's actually a formula. So we're going to use control semicolon, which is a Macabacus shortcut to toggle between blue and black. In our equal amortizing loan, which is principal plus interest, there's no single payment. The payment is of principal, and then there's a separate payment of interest. So in order to calculate the principal payment, we don't need a PMT function. What we need is to take the full loan amount, and because it's equal amortizing, we're simply going to divide it by the number of months over which it amortizes. And here we have the monthly principal obligation. Over here, we have the monthly blended payment obligation. Let's actually look now and start to build our amortization schedule. So we see here that we have month 0, which is when the loan was dispersed. And of course, the balance at month 0 is the original loan amount. Now using F4, we're going to fix this cell. So using F2, we can see the formula. It's fixed with these little dollar signs, which means as we fill down, it's not going to drag this number with it. Now for payment, an easy way to do this would be simply to link to this payment amount and fix that cell. But we want to actually copy that number, and you'll see why later. I'm going to show you an interesting little trick when it comes to fixed versus variable rate loans and equal payment or blended payments. So what we're going to do is actually copy, Control C, and in month one, we're going to paste special, which is Control Alt V. It's going to give us some options. So what we want is just the values, not the formula. We can toggle the color because that's effectively an input as opposed to a formula. This is important, you'll see here, because our numbers are rounded, but there are actually some cents involved. If we don't have the correct amount from the PMT function, then we run the risk of the loan not being actually zero balance at the end. So one thing we do know is embedded within this blended payment is some amount of principal and some amount of interest. In order to figure out how much the principal is, we have to calculate the amount of interest. And the amount of interest is the monthly rate, which we're going to fix using F4, multiplied by the ending balance in the previous period, which in this case was the full loan amount. So of the $18,871, $41.67 was interest. Principal, obviously, is the difference. So the total payment less the interest amount equals our principal amount. Now what happens to the loan balance? The loan balance goes down by the principal amount. So we're going to take the original less the principal amount paid within the blended payment, and we have our new balance. We're going to use a Macabacus function here called fast fill down, and the shortcut key is Control-Shift-D, and that will actually automatically fill all the way to the bottom of the existing reference cells. So because this ends at 60, it goes all the way down to the bottom, and we can see here that our blended payments are made all the way down. These are actually formulas, so if we want to be exact, because these equal the cell above, we can make those black. You can see that the principal portion gets larger with each payment, and the interest portion gets smaller because the interest is being charged on a reducing balance. And of course, as we get to the very bottom, as we would expect, our loan balance is zero at the end of 60 months. Now we can actually build out our equal amortizing, or what's called our principal plus interest payment reducing term loan. You'll see that the column headings are the same as in the blended, but we're going to arrive at the numbers and the calculations within each column a little bit differently. The balance will be the same. So it starts at the full amount outstanding. We're going to fix the cell. It's $1 million at loan disbursement. The one variable that we know is the actual principal payment amount. So here we can actually link using a formula. So we know that there's going to be 60 equal payments of $16,671. We're going to fix that amount. And similar to the blended version, we know that some amount of interest is also being charged. So for month one, it's going to be calculated the same way as the blended version, which is fix our cell here, the monthly rate, multiplied by the balance at the end of the previous month. Now, instead of working from a payment amount less interest, we know that this column is going to be calculated in an additive fashion. So the total payment amount that the customer needs to make is going to be the principal amount plus the interest amount. So right away, early on, we see that the total payments for the customer are higher early on than we see over here in the blended amount. But the amount of principal, even from the first payment, is also higher. We now need to calculate the balance outstanding at the end of month 1. So we're going to take the previous month's balance, and we're going to subtract the amount of principal that was paid. Just like before, we will select across. We'll use our shortcut Control-Shift-D to fast fill, and we can scroll all the way down to see that at the end, indeed, our principal outstanding is 0. Now that we've built both amortization schedules, let's try to better understand some of the interesting characteristics about both. First, I want to talk about fixed versus variable rates, which we covered earlier in the chapter. Equal amortizing, or principal plus interest loans, lend themselves very well to a variable rate because this interest amount or this interest payment is going to fluctuate as the base rate goes up or down, and the debtor or the borrower is accustomed to having a different payment amount. So because the principal goes down by the same amount each month, a change in interest rate isn't going to affect the loan's ability to be paid off at the end of the term. That's not the case in a blended structure. So if we look down at the bottom, we see in both instances it goes to $0. Well, what happens if this rate were to go up? Say it was a variable rate and the base rate goes up by 1%, so the client's all-in rate would go to 6%. This is why we hard-coded this payment. So let's say 6%. Look at the bottom, what happens to our loan amount. At the end, because the original blended payment was calculated based on a certain interest rate, and then the proportion of principal and interest would change throughout the course of the loan term or the amortization period, what we end up with is a bunch of principal still outstanding at the end of the 60 months because the interest rate went up, which means the proportion of interest relative to principal changed. See, the fixed payment amount stayed the same. Previously, it was $4,167. So the amount of principal being paid off each month goes down, and it leaves us with an unusual situation. So as a credit professional, when you're structuring deals for a client and they want to take a variable rate, the smart structure is to use an equal amortizing structure or a principal plus interest as opposed to an equal payment or a blended payment structure, which is much better suited to a fixed rate term loan. One of the other interesting characteristics about these two different types of loans, which are equal payment or blended and equal amortizing or P&I, which is principal plus interest, is the actual amount of interest paid over the course of the loan in the amortization period. So to make sure we're comparing apples to apples, we will plug 5% back in and double check. And yes, this does go back to 0. So let's actually calculate some totals. Using alt equals, we have a fast sum formula. And then we will copy. We can fill right using Control R. As we know, calculations should be separated by a border. So we're going to use kind of a fun Macabacus shortcut. And we're going to highlight. And the bottom border cycle is Control-Alt-Shift down. We're going to click twice. Will give us our line here. Now we can actually just copy this and paste it over here, and the formulas will go with it. From a formatting perspective, we want to make sure we toggle through our border cycle again, Control-Alt-Shift down arrow. Here we match. Now let's have a look at the total payments in columns I and column C. So the total payments over the course of 60 months in a blended structure is slightly higher. So it's higher by a little over $5,000. The principal amount, as we expect, would be the same. There's only $1 million outstanding. The difference is in the interest. So in a blended structure, more interest is paid over the course of a loan. This is only a 60-month loan, but you could imagine if the amortization was 25 or 30 years, this difference could be quite material if it was a residential or a commercial mortgage. So understanding the total amount of interest that it's going to cost a borrower is another function when having a discussion with a client or a prospect about loan structure. You need to understand it and be able to make it clear to your client or your prospect that one is going to potentially cost more than another. And given what we know about variable versus fixed, if it's a variable rate loan and we're in a rising rate environment, this difference could be much more. Whereas here, the fixed rate we know is going to be locked in. The inverse, of course, is true as well. If the rate were to go down, then the total interest paid could actually be significantly lower by a larger amount. As we discussed earlier in the course, a commercial lender will register charges against its borrower's assets using public security filings. These assets are what we call collateral security, and the lender can use this collateral to sell and recover loan proceeds if the borrower ever defaults on its exposure. While the nature of the charges vary by country, it's common to use something like a general security agreement or a GSA, which is a floating charge over all the borrower's assets. In this sense, it's very rare to see truly unsecured commercial lending, since credit is virtually always backstopped by a general security agreement. What we mean by a secured loan is that some credit is backstopped by a specific charge over a specific asset. A great example is a commercial real estate loan. Any credit outstanding to support the acquisition of commercial property will be secured by that property itself, using something called a collateral mortgage agreement. Another is manufacturing equipment or machinery, like a forklift maybe. If a loan is extended to support the acquisition of machinery, the lender may wish to secure its exposure by registering a charge over the specific serial number of that machine. So when we talk about unsecured credit in commercial lending, what we generally mean is credit that is not secured by a specific asset, but rather by the creditworthiness of the borrower and by its general asset base. Truly unsecured credit does exist, however, in personal lending. Think about a credit card, for example. A student line of credit, too, has no specific underlying asset. Secured credit is also common in retail borrowing, like home mortgages and car loans. In general, and all other factors being equal, secured credit tends to have a lower interest rate than unsecured credit, since a strong and specific collateral position makes the risk of loan loss a little lower.